Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host here from the floor of the CME Group in New York. My guest today is Paul Sachs, Chief Investment Officer of Aurum Options Strategies. Paul, thanks very much for coming on the show.
Thanks for having me.
So, before we get into what it is that you do, which is essentially the options market, and I'm very interested just to kind of pick your brain on that, just give us sort of a background, big picture, macro view of gold. I know that's your specialty. That's really what you focus on. I know lots of geopolitical cross currents now and other things. How do you see sort of what's going on in terms of gold? It's been in a tight range for a long time.
Yeah, it really has been. 2014 is shaping up to be a very interesting and important year for gold, in particular after the liquidation in 2013, where there was this massive selling of paper gold in the West, which ended up getting refined and shipped to the East, in all likelihood never to see the light of day again. So the price did fall about 28% last year, and there's been a little bit of a rebound this year also in the gold equities. So why is that happening? There is this idea that people are taking advantage of the lower prices. Typically they really do key in on whether there's physical demand for gold coming out of the East. They are price sensitive. They don't just buy it blindly. So that does tend to appear when we go below 1,300, and when we get above 1,300, there's a little bit less demand, right? So then we start focusing on whether there's any geopolitical situations getting worse, as there has been this year, unfortunately, and also things like domestic economic reports, like GDP, much better than expected. Of course, that's bearish for gold, so on and so forth.
Now, it's interesting because Goldman Sachs recently came out with what I would call a fairly bearish outlook for gold, saying that it could go down to about, I think it was about 1,050 was the level, but then they said, but 1,240 was the real floor, or 1,200 was the real floor. I kind of didn't understand that. Did you make any heads or tails out of that one?
Yeah, I mean, look, welcome to dealing with Goldman. They've been bearish from the beginning of the year, basically based on this idea of an economic recovery domestically. Okay, that should lead to higher interest rates, that should lead to a stronger dollar, and that, of course, is quite bearish for gold. In other words, less of a need for a tail risk hedge. That's their main thesis. It's still more or less intact. It's just been thrown off course a bit by some of these geopolitical concerns, let's say. They've slightly hedged their original statement by putting up this 1,200 to 1,240 floor, talking about the cost of production from miners, and when it goes below that, they cease production, and that in and of itself can be bullish for the gold market. But I feel they're basically sticking to their guns. They do see lower prices.
And you never know about Goldman. They might say lower prices, but they're secretly buying, right?
Absolutely.
Okay, now I want to talk to you. Your specialization is in the area of options. Very interesting. I want to pick your brain a little bit, because is there anything that you're seeing right now in terms of option activity that could give us clues as to the next price movement? I know there's been a lot of talk about declining volatility. I guess you see a lot of spread activity or whatnot, selling premium. But do you see anything that's kind of, odd right now, or maybe pointing to some sort of new players coming in, a directional shift?
Yes, certainly. So as you pointed out, volatility is low, and there's nothing special about gold there. It's low across all asset classes, and there's a host of reasons for that. But I will say this, we do very carefully monitor the difference in demand for calls as compared to puts. We call that skew or skewness. It is high. There is demand for calls relative to puts. It's been high all year, and it is not going down. That is basically indicating to you that order flow is such that they are coming for the calls. They do want the upside exposure. They prefer this to buying gold outright, especially after what happened last year, but they are seeing this idea of it's worth having some upside calls just in case something happens.
So you noted that this is kind of new for this year, so you weren't seeing that activity as much, maybe not at all last year, correct?
Yes, that is correct, especially with what happened last year in the gold market. Puts were in tremendous demand, and they traded at a much higher volatility as compared to calls. And the volatility price is the way by which we determine the demand for the particular option. Last year and the previous years was much more about the puts. This year looks like it's starting to shape up to be about the calls.
Now, again, you focus on gold. I'm sure people you talk to the gold story is it's a great long-term hedge. It's an insurance policy against risk or paper currency or inflation. How are people handling, we saw the big run-up, which peaked in 2011. It came down. I think you just recently mentioned that a lot of people, sold paper gold last year, got out. Is that frustration a good sign that maybe we're seeing a bottom here?
Yeah, sometimes it is nice to buy it when there's blood in the streets, right? It's really a function of whether we're talking about trading gold or investing in gold. Now, there's an old saying on the floor, how do you make a small fortune trading gold? Start with a large one. I know you've heard that. But I agree with your thesis completely about whether or not one should have an allocation to gold in terms of a long-term investment. Of course, I agree, and it's just a matter of how one wants to do that. A lot of people do have a small allocation to the GLD, a gold ETF. Some people have buried gold coins or bars in a basement or in their backyard. Or they can pay someone to store it. My preference is maintaining some type of leveraged upside exposure to the gold market using the options. Okay, this does require carefully crafting spreads that are more or less premium neutral, so that in the event that nothing does happen, you don't just erode all your premium away.
Okay, spreads that are premium neutral, that might go over the heads of many people. Can you break that down for us?
Yeah, sure.
What would you recommend for people who want to put on an option strategy long gold?
Right. So first of all, you want to never have an option strategy that has the potential for unlimited losses. That means that when you look at your position and you count up the number of calls that you're long and you subtract from that the number of calls that you're short, at worst, you don't want to. You can have a zero. You never want to have a negative number, right? You always want to be what we call
more long calls.
Net long calls, exactly. But beyond that, there's different sort of tenors or lengths or dates at which these options expire, and there's different values attached to those different dates or different tenors, as we say. So you can play around with ratios and come up with spreads that are in fact, first, net long calls, but second, flat premium or even short premium.
So it also depends very much on the risk tolerance of the investor, right? I mean, you could your premium could be large if you're making a very leveraged bet, right? Or you can really, by using those spreads, take the premium way down. It's a more conservative bet, but you still get the leverage, correct?
Right, that's correct. I mean, derivatives get a lot of bad press, right? Usually they're associated with some bank blowing up or some trade desk blowing out. But the truth of the matter is that's just because they were used irresponsibly.
Banks doing things irresponsibly?
I know, shocking, breaking news here. I know.
Newsflash.
But basically, you don't want to be bringing your rent money to the options market. I'll say that to begin with. But that being said, it is possible to really have very risk-averse positions using options. I mean, look, these are instruments originally created for the mitigation of risk, for managing the risk. You can use them to take more risk, but you can also use them as they were intended, to mitigate risk, and that's the way we basically approach it.
So for the average person, the learning curve to understand a strategy like that, is it very complicated?
Okay, so I've been at it 17 years. I still am learning, so you can't just go talk to someone who knows a lot about options and they brain dump and then you know everything that they know. It takes a long time. And there's this idea of understanding options academically in the textbook, what the formulas are, but then there's the real world trading. These option models are not perfect. There are these little non-linearities, or there's little areas where these models break down. And the real world can't be modeled perfectly. So there's always going to be someone on the other side of the table with deeper pockets. So you always have to have the appropriate sized position and the appropriate type of position.
That's why it's always good to know an expert like you. Yeah. Paul, thank you very much.
Thanks for having me.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.